Hello friends, तुम्हा सर्वांचं इयत्ता 12वी सेक्रेटरी प्रॅक्टिस या विषयाच्या या व्हिडिओ लेक्चरमध्ये हार्दिक स्वागत. बिफोर स्टार्टिंग दिस व्हिडिओ लेक्चर, I just revised what we studied in previous lectures of this topic, that is sources of corporate finance. We studied own sources, equity shares, retained earnings, preference shares, its features, retained earnings, its determinants, advantages and disadvantages. In borrowed sources, we completed debenture, what is meant by debenture, various definitions of debenture, types and features of debentures. So through this video lecture we continue the remaining part of the topic. Specifically in this video lecture we are studying only bond, the concept of bond, various features of bond and types of bond. So first of all we start from definitions. So the first definition of bond: a bond is a debt investment in which an investor loans money or lend money to entity, typically corporate or for government, which borrows the fund, that is corporate or government, for a definite period of time at a variable or fixed interest rate. So basically bond is a debt instrument through which an investor invests money or gives money as a loan to corporate or any company or to the government. So the corporate or government borrows money for a definite fixed period of time at a fixed or variable interest rate, because please keep in mind, on borrowed capital investor get interest. Maybe there is different source, that is maybe there is debenture, deposits, bonds, loan, but the investor get interest. So bond is a debt instrument through which corporate or government borrows the funds for a definite period of time at a variable or fixed interest rate. Next definition: a bond is an instrument of indebtedness of the bond issuer to the holder. Then what is meant by instrument of indebtedness of the bond issuer to the holder? Through this instrument, that is through the bond instrument, when any person invests its money in the form of bonds, the bonds creates indebtedness on the issuer. Issuer may be corporate, issuer may be government. Means bonds creates loan, bonds creates debt on the company or on the government. It is a debt security under which the issuer owes the holder a debt. It is a debt security. Security in the sense, not any, the word security is used not for the purpose of safety, but the one of the instrument through which, like shared venture deposits, it is also one of the security or instrument through which company collect finance. That's why it is the word is used as security, under which the issuer owes the holder a debt. जो इश्युअर आहे, जी इश्यू करणारी कंपनी आहे ती ओज आहे. ओज मीन्स देणे असणे. द होल्डर अ डेट, कर्ज देणे आहे. अँड डिपेंडिंग अपॉन द टर्म्स ऑफ बॉन्ड, डिपेंडिंग ऑन the terms of bond, while making agreement at the time of purchasing bonds, the terms and conditions of issuing bonds are decided. So depending on the terms of the bond, is obliged to pay them interest, or interest ला दुसरा शब्द आहे coupon, and to repay the principal at a later date termed the maturity date, till the maturity date. So bond is an instrument which creates indebtedness on the issuer. It is a debt or loan instrument, debt or loan security. The issuer owes the holder a debt, and depending on the terms of the bond, is obliged to pay them interest, the coupon, or to repay the principal at a later date termed maturity date. Next definition: a bond is an interest bearing certificate issued by the government or business firm. बॉन्ड काय आहे? एक इंटरेस्ट बेअरिंग सर्टिफिकेट की ज्याच्यावरती कंपनी जो इश्यू करणार, बॉन्ड इश्यू करणारी व्यक्ती आहे, जो भी बॉन्ड इश्यू करता है, मे बी इट इज अ गवर्नमेंट और अ बिजनेस फर्म, which make a promise to pay interest on bond to the holder at a specific sum at a specified date. Webster Dictionary. So bond is a interest bearing certificate issued by the government or a business firm. Next definition: a written and signed promise to pay a certain sum of money on a certain date or on fulfillment of specified condition a written and signed promise. So bond is a written and signed promise to pay certain sum of money on certain date, that is meant at the time of maturity period or on fulfillment of specified condition. If there is any condition is made between signing the promise, all documents contracted and loan agreements are bonds. Business dictionary. So bond is a written and signed promise to pay certain sum of money on certain date, fulfillment of specified condition, all documented contracts, loan agreements are bonds. Business dictionary. So from all above four definitions, after making analysis of these four definitions, we come to certain conclusions that the bond is a formal contract or written promise. Bond is formal contract or written promise to repay borrowed money with interest on particular date. Bond is a debt instrument. The bondholder are known as the creditors of the company. They are generally unsecured. Like a debenture, they are not secured. They are generally unsecured but provide finance for more than 10 years to business. More than 10 years. So the maturity period of bonds is more than 10 years and maturity period of debenture is up to 10 years. Next, features of bond contract. Bond is a formal contract between the company and bondholder. So bond is a contract between bondholder and the company or the issuer of bond. So it is a formal contract between issuer and bondholder. In this contract, company promises to repay the borrowed amount with interest or without interest. So in this contract, company make a promise to the bondholder that the company pay the amount of bond, that is principal amount of bond, without interest or with interest. So basically we discussed that the bond is a contract. So while signing the contract with the company, investor know all the facts and features, terms and conditions relating to issue of bonds. This contract includes all terms and conditions regarding interest payment as well as repayment of principal amount. This contract includes all terms and conditions regarding interest payments and as well as repayment of principal amount. If bond are secured by assets, that time in the contract involve third party known as a bond trustees. Then what is why bond trustees are needed? Bond trustees are work as a middleman between company and bondholder and protect the interest of bondholder on behalf of bondholders. Next feature, that is nature of finance. Bond provides a long-term finance to the company or government. Normally the period for which the bonds is issued is more than 10 years, but some companies issue bonds for 5 years also. So company use this capital which is raised through bonds for fulfilling a fixed capital requirement. A bond is a loan capital, therefore it is a less risky than share capital. Why? Because bondholders are the creditors of the company, means, and bondholders creates debt on the company. Bondholder creates loan on the company. That's why bondholders is a less risky capital compared to share capital. Next feature, that is status of investor. The bondholder is one of the source of borrowed capital. Therefore, bondholder, like all other borrowed capital holders, treated as the creditors of the company. They don't have right to participate in the management of the company, that is creditors of the company. They don't have enjoy membership right such as voting right and management right. So bondholders are creditors of the company. Next, return on bond. It is a borrowed capital, therefore company provide interest as a return on investment to the bondholders. Return on investment in the form of interest as a return on. The rate of interest may be fixed or floating. The interest may be paid annually or on maturity period. The interest may be paid annually or on maturity period, or as per the terms and conditions decided at the time of signing contract between company and bondholder. Next, repayment of amount. It is a formal agreement between the company and the bondholder to repay principal amount on a particular date. As we discussed earlier, it is formal contract. It is an agreement through which principal amount on a particular date, company bondholder to repay principal amount on a particular date. The maturity date of bond mentioned in the prospectus and bond certificate. Maturity date, that is all terms and conditions relating to the repayment of bonds, repayment of a repayment of capital, repayment of bond, payment of interest, rate of interest, terms and conditions relating to the payment of interest, type of bonds. So all these things are mentioned on the bond certificate and prospectus. If company fails to pay the amount of bond as per terms and conditions decided at the time of signing contract, so the company it is considered as a default of the company. Company may be penalized by company law. Guarantee by government. If bonds are issued by government company, then they are guaranteed by central government or Reserve Bank of India. When if bonds are issued by government company or on behalf of government, if central governments on behalf of central government, if Reserve Bank of India issued bonds, then it is a guarantee taken by government as a part of today's current COVID-19 situation. Government, that is central government of India, to raise finance to minimize, to pay the expenditure on COVID-19, government issue a 7.85 interest rate bond of 7 years before in May 2020, and these government bonds are issued by Reserve Bank of India on behalf of central government. So RBI always ready to purchase the government bonds from the market. There is no chance of a risk in bond investment if government take a guarantee. If government take a guarantee of bonds, or if the bond is of a government bonds. Tax benefits. When bonds issued by infrastructural development companies, these bonds provide tax benefits to the holder under income tax. The investment not considered for income tax calculation. These investment not considered for income tax calculation. Next, parties to the bond issuing bonds. Company, government or issuer of bond. It is an organization that issue bonds. Bondholder, a person who invests money in the bonds and receive bond certificate as evidence to provide loan to the company, known as a bondholder. Trustee. If bonds are secured by assets of the company, at that time trustees are involved. Trustees are the representatives of the bondholder. They protect the right of bondholder. They act as a middleman or link between company and bondholder. For this purpose, company make an agreement with the trustees known as a trust deed. This concept or this word is important for one word situation. Trust deed. It includes the obligation of company, right and duties of bondholder. So in our textbook, that is as per new syllabus which changed from this year, only the features and meaning of bond is covered. But sometimes question is asked on the types of bond also. That's why for exam purpose today I cover here types of bonds also. So followings are the types of bonds. Bonds based on coupon means interest rate, based on option, that is buy option or sell option, based on redemption, that is a repayment, based on terms and conditions of repayment. Based on coupon or interest rate, there are fixed rate bonds, floating means changeable interest rate bonds, zero coupon bonds means no interest bonds, deep discount bonds, and with based on option, bond with call option and bond with put option. Based on repayment, that is redemption payment, single redemption and amortizing bonds. So first of all, we start the bonds based on coupon or interest. Bonds based on coupon or interest rate. Fixed rate bonds. These bonds get fixed rate of interest throughout the bond period. The interest rate never changes during the bond life. Means while signing the contract, one condition is there that these bonds are issued for fixed interest rate, or these bonds carrying fixed interest rates throughout the lifetime of the bonds. Next, floating rate bonds. Floating means changeable or which is not fixed. These bonds have variable rate of interest. Variable means changeable, which is not fixed. Interest rates are recalculated periodically. The interest rate depends upon company's financial position and RBI's guidelines or regulations. If companies earn higher returns or much more profit, or company's profit is increases, then the rate of interest also increases. That is floating rate bond, or the rate of interest is variable, which is not fixed. Next, zero coupon bond. On these bonds are issued at normal discount less than face value. No coupon oblique interest is paid to zero coupon bonds. On the maturity, these bonds are redeemed at par, and the profit for the investor is difference between acquisition cost, that is cost of issue of bonds, and face value is the profit for the investor. Means if the face value of bond is rupees 1000 and bond is issued at 10% discount, for 900 rupees, and bonds are redeemed at face value, that is for 1000. So the difference between 1000 and 900 is the profit for the investor, that is rupees 100. So it is known as a zero coupon bond. Deep discount bond. These bonds are similar to zero interest bonds but have huge discount and long period of maturity, that is 25 years or more than that. These bonds do not get interest. These bonds are redeemed at par. The difference between acquisition cost and maturity value is profit for the investor. Means like a zero coupon bonds, these bonds are also issued at discount, but these bonds are also similar nature of zero coupon bonds or zero interest bonds, but companies issued these bonds at huge discount compared to zero coupon bonds. Huge discount. The discount is more than zero coupon bonds. and long period of maturity, 25 years or more than that. Next, inflation indexed bonds. The principal amount of bond and the interest rate are charged as per index of the inflation. That what is meant by inflation? Inflation मराठीमध्ये महागाई, प्रॉपर मीनिंग सांगतो इन्फ्लेशनचं. Increase in general price level of goods over a period of time known as inflation. सातत्यानं गुड्स आणि सर्व्हिसेसच्या किमतीमध्ये होत जाणारी वाढ म्हणजे महागाई किंवा इन्फ्लेशन. The principal amount grows and payment of interest increases with the inflation. The inflation indexed declared by RBI on every 6 months. For example, if in first half year index inflation is 6% and after end of year the inflation rate is 8%, so the interest is calculated on the inflation which is increased, it is on 8%. So the principal amount grows and payment of interest increases with the inflation. Inflation म्हणजे महागाई. Next, based on option, bond with call option, that is callable bonds, and bonds with put option, that is puttable bonds. Now what is meant by bonds with call option and what is meant by bonds with put option? First, what is meant by bond with call option? This feature gives a right to issuer, that is issuer means the company who issue bonds, the right to redeem. Redeem means repay his issue of bonds before the maturity of bonds at a predetermined price and date known as a callable bonds. It is a repay by company before maturity period. जर कंपनीनं स्वतःचे बॉन्ड्स स्वतः विकत घेतले किंवा रिपे त्याची अमाऊंट जर रिपे केली ॲट अ प्रीडिटर्माइंड प्राइस अँड डेट तर त्याला म्हणतात कॉलेबल बॉन्ड्स. नेक्स्ट, बॉन्ड्स विथ पुट ऑप्शन. द फीचर गिव्स बॉन्ड होल्डर द राईट टू सेल देअर बॉन्ड्स बॅक टू द इश्युअर ॲट द प्रीडिटर्माइंड प्राइस अँड डेट. This feature gives bondholder the right to sell their bonds back to issuer at the predetermined price and date. It is a surrender or return by investor to the company before maturity period. It is put option. या प्रकारच्या बॉन्डमध्ये बॉन्ड होल्डर स्वतः कंपनीला किंवा गव्हर्नमेंटला ते जे बॉन्ड आहेत तर ते बॉन्ड सेल करतात. दॅट इज सेल देअर बॉन्ड्स बॅक टू इश्युअर ॲट अ प्रीडिटर्माइंड प्राइस अँड डेट. इट इज अ सरेंडर बाय इन्व्हेस्टर बिफोर मॅच्युरिटी पिरियड. मॅच्युरिटी पिरियड संपण्याच्या आधीच ते बॉन्ड्स रिपेमेंट केले जातात किंवा सरेंडर केले जातात. Next, based on redemption, bond with single redemption and amortizing bonds. These bonds are also known as bullet bonds. They cannot be redeemed before the maturity period. These bonds are also known as bullet bonds, that is single redemption bonds is also known as bullet bonds. They cannot be redeemed before the maturity period. Like putable bonds and callable bonds, these bonds cannot be redeemed before maturity period. In this case, principal amount of bond is paid at the time of maturity only. या बॉन्डची जी मॅच्युरिटी प्रिन्सिपल अमाऊंट आहे तर ती फक्त मॅच्युरिटीलाच रिपे केली जाईल, ओनली ॲट द टाइम ऑफ मॅच्युरिटी ओनली. देर इज अ सिंगल मॅच्युरिटी डेट and all the bonds issued to various investors are redeemed on that single maturity date. These bonds are may be issued at discount. These types of bonds are issued by company and maturity period, and these bonds are cannot be redeemed or repaid before maturity period. These bonds is redeemed at a single maturity date, and these bonds are issued to various investors on that single maturity date. So these bonds may be issued at discount. Next, amortizing bonds. In this case, payment is made by the borrower, that is issuer, on maturity includes both interest and principal. These bonds may be repaid annually in installments, that is principal of bond plus interest. amortizing बॉन्ड म्हणजे असे बॉन्ड आहेत की ज्यांच्यावरचं इंटरेस्ट आणि प्रिन्सिपल हे मॅच्युरिटीलाच पे केलं जाईल किंवा ॲन्युअल इन्स्टॉलमेंटमध्ये प्रिन्सिपल विथ इंटरेस्ट पे केलं जाईल. सो फॉर टुडे I stop here. The types of bond is not covered in our textbook, that is in new revised syllabus, but for your reference, if question is asked on the types of bonds, then you are always ready to answer the questions on types of bonds. Today we covered features, types, meaning, definitions of bond. After watching this video, you have to write down define bond, explain its features with types as a question for 8 marks. And if you find this video is helpful to you, then please subscribe my channel Sridesh 999. Thanks for watching.